All right, today we're going to tear apart a pretty detailed equity research report on Alphabet. And the goal here is to really understand its super strong buy thesis. The report basically argues that the market is fundamentally mispricing one of the most dominant companies on the planet. And we're going to unpack exactly why they think that. Okay, so let's get right into it. The report doesn't just kinda sorta recommend buying Alphabet. No, it does so with a very high level of conviction, and that really sets a powerful stage for this entire analysis. And boom, there it is, in black and white, a super bold call with a very specific price target. This isn't just some soft recommendation, it's a firm stance. It's built on the idea that Alphabet stock has some serious room to run.
And that just begs the question, right? If the case is so strong, what is everybody else missing? The report really frames its entire thesis as the answer to this one single puzzle.
So the whole bull case really boils down to three core ideas, three massive growth engines that this report believes Wall Street is either completely misunderstanding or just seriously underappreciating. Let's break them down.
First step, artificial intelligence. Now, you've probably heard the narrative, right? That AI is just this giant, margin-crushing money pit for Google as it tries to defend its search business. But this report argues the exact opposite, that AI is actually building them an incredible competitive advantage, a moat.
And check this out. This is where it gets really interesting. This is from a Google technical paper. A single Gemini AI prompt is now actually more energy efficient than a classic Google search. I mean, that totally flips the script on the idea that AI is just inherently more expensive to run.
And this number, 33x, just puts it all into perspective. We're talking about a 33-fold drop in energy use for AI prompts in just the last year, all while usage has exploded. So this isn't just a cost center. It's rapidly becoming a hyper-efficiency machine.
All right, pillar number 2, the cloud profitability engine. You know, for years, Google Cloud was kind of the problem child in the family, just burning through cash. But the argument here is that it's finally hit this major turning point, and it's turning into a massive profit driver.
I mean, just look at this growth. We're talking a 32% jump in revenue year over year, hitting over $13.6 billion. It is gobbling up market share in an industry that's just getting bigger and bigger. But here's the real kicker. It's not just about getting bigger, it's about getting profitable. The operating margin almost doubled in 1 year, jumping from about 11% to over 20%. This thing is no longer just a growth story. It's a cash machine in its own right.
And that brings us to the third and final pillar. This one's kind of a two-parter. You've got the rock-solid, unwavering dominance of their core businesses, and then you've got this brand new and very significant shift in how they give cash back to shareholders. I mean, let's be real. The core of this company is an absolute fortress. Search has, what, a 90% stranglehold on the market. Android is on basically every phone that isn't an iPhone. And YouTube, 2.7 times billion monthly users. These aren't just businesses. They're cash-printing institutions.
And all that cash they're printing? Well, it's now coming back to investors in a huge new way. Think about it. They just started their first ever dividend. Plus, they authorized a massive $70 billion share buyback. This is the company basically telling the world, we're all grown up and we are serious about shareholder returns.
Okay, so let's recap. You've got this super efficient AI, a cloud business that's exploding with profit, and this unbeatable core. You'd think this stock would be trading at a crazy premium, right? Well, that's where the story gets weird. This is the valuation disconnect.
And to really get this, we got to talk about the PE ratio. All it is really is a quick way to see if a stock is cheap or expensive compared to its profits. A lower number generally suggests it's cheaper.
And this chart is where you can see the disconnect plain as day. Look at Alphabet, trading at just under 23 times earnings. Now look at its buddies. Microsoft is way up there at 37, Amazon almost 34. It's trading at a massive discount compared to the rest of the big tech crew. The report says that is the opportunity.
Okay, but let's be fair, a discount like that doesn't just happen for no reason. So now we have to look at the other side of the coin. What are the big risks, the headwinds that are clearly scaring some people off?
Well, the elephant in the room is regulation. The Department of Justice has been all over them, and the big unknown is what the penalties, or the remedy, will be. But here's the key insight from the report. Wall Street is probably already bracing for the worst. So if the final outcome is anything less than a full-blown breakup, it could actually be a good thing for the stock, just because all that uncertainty would finally be gone. Then you've got the competition in search.
Yeah, market share has slipped a tiny bit, and it's true. Younger folks, Gen Z, are starting to search on places like TikTok and Reddit. That's a real shift. But the counter-argument is that Google's sheer scale and the fact that they're plugging their own AI into everything gives them a pretty powerful defense against these new threats.
And last but not least, you have to look at what the insiders are doing, and the numbers don't lie. In the last 90 days, we've seen over $50 million in sales from insiders and 0 buys on the open market. You can't just brush that off.
So what do we make of that? Well, the report gives us this classic piece of Wall Street wisdom. Insiders sell for a million reasons, but they really only buy for one. They buy when they think the stock is an absolute steal. The fact that nobody is buying, it's a signal. It doesn't kill the bull case, but it does suggest this isn't an overnight story. It supports that 12 to 18-month time frame to let all these catalysts really play out.
All right, so we've looked at the good, the bad, and the ugly. The powerful bull case versus some pretty serious risks. So, what's the final verdict? Where does the report land?
And it all boils down to this. The final verdict is that the market is just too hung up on the regulatory stuff, risks that are probably already baked into the price. And in doing so, it's missing the bigger picture, the incredible long-term value being built in AI, in the cloud, and in that unstoppable core business.
So that leaves us with the one question that really matters going forward. We know they're building this massive AI advantage, but the real test, the thing that will decide if this stock ever hits that $237 price target, is how fast can they actually turn all that amazing tech into cold, hard cash. That right there is the story to watch.